What is going on, everybody? This is Adam Lang with my co host, Benjamin Adams, on a brand new episode of the Pursuit of Progress podcast. We're doing this one a little bit off the cuff today because we've been getting a lot of questions from our audience, as well as just from Ben, getting a lot of current clients and just people reaching out to him since he is one of the top mortgage lenders here in Denver, as well as really all across the country. He's one of the few that are actually licensed in all 50 states. And there's just been a lot of talk recently, just with financial, just kind of how to improve your overall portfolio of investing. Maybe you have a single family home, maybe you have a few properties, maybe you're just trying to get into real estate investing, or maybe you're just trying to kind of consolidate what you currently have. This product that Ben is going to share with us today is just something that I think can really provide a lot of value to certain people that maybe this applies to. This might not be an episode that relates to all of you guys, but I think regardless, it's still something worth listening to. It's going to be a quick, kind of a short and dirty episode, just talking through this all-in-one product that Ben has, I think, only been having this now for a couple of years that you've been kind of really rolling this out and offering to clients. And I know you actually are also using it yourself. So that was a long-winded intro without even letting Ben chat yet. But guys, I'm excited to have Ben share with us a little bit more about this all-in-one product.
Oh, thank you so much. And this is a game-changing product. It's something that has the ability to accelerate wealth building, accelerate principal pay down, and allow someone to be debt-free and mortgage-free exponentially faster. Now, I always start off the conversation with all my customers by saying this mortgage is probably not appropriate. Well, this mortgage is not appropriate for 79% of Americans. And the reason for that is because 79% of Americans live either paycheck to paycheck or they have less than a $2,000 emergency fund saved. So this is not a product that's going to be appropriate for most Americans. This is also not going to be a product that's appropriate for a first-time homebuyer. This is more of a financial tool than it is a mortgage. And what is the all-in-one? So let's just start there. The all-in-one is a first lien home equity line of credit that is synced to a checking account. And believe it or not, it's how the rest of the world does mortgage. So this is the type of mortgage financing that you're going to find in Europe, that you're going to find in most of Canada and even Australia. Here in the United States, we've been brainwashed on the 30-year fixed. And the reason for that is because there was so much trauma that happened in our economy from the fallout of 2007, 2008. So the rest of the world has done mortgage like this forever. It's been in the United States, this specific product, for over 20 years, but it's really just starting to reemerge. And so how do you know if this product is appropriate for you? Well, if you're someone that is financially literate, you have financial goals, you want to build wealth, you want to accelerate the wealth building for your family, if you want to get your mortgage paid off, you have real goals. You're not living paycheck to paycheck, meaning that there's more money coming in every month than is going out. This might be something you want to consider. Now, on one of our websites, you can actually, we have a financial tool that you can run. It's called the North Point All-in-One Calculator, and it's going to ask for all of your financial information. So what is your net income? What's your existing mortgage? What's the interest rate on that? How much, what is the loan term, the loan balance, the property taxes? What are all of your other bills? And then you compare that to what your income is, and you input all of your information on this financial calculator, and it'll actually tell you how quickly you can get your mortgage paid off. And a lot of times the results can be very shocking. Even with someone on a 30-year fix that has an interest rate in the twos, what's great about this is that if you have a positive monthly surplus, you don't have to change your monthly spending habits. And so one of the kind of the pushbacks from the consumer is, well, I have a 2.9% of my 30-year fixed. I can always pay more on my existing mortgage. Well, you can, and that's also a strategy. And you can, by paying more, you will, assumedly pay extra principal, which will then allow you to pay less in interest. And then that'll allow for a shorter amortization. So instead of a 30-year, if you're paying $1,000 extra per month, it's going to turn the loan into a 20-year, maybe even a 15, depending on what the loan balance is. So, but two things happen there. Number one, you actually have to pay more. So if your mortgage payment is $3,500 a month and you want to pay $1,000 extra, you actually have to pay $1,000 extra every month. So your cash flow is being reduced by $1,000 from what it would be otherwise. With the all-in-one, you don't have to change your cash flow at all. You put all of your money, so all of your sources of income from your job, your salary, maybe you have passive income or rental properties. You set all of that to go into the all in one checking account. And then every night at midnight, whether you get paid once a month or get paid several times a month, whenever you get paid, the money goes into the all in one checking account. And then at midnight every night, it then gets transferred over to the principal balance of the first lien home equity line of credit, dollar for dollar in real time. So, what that does, let's say that you have a $10,000 deposit that goes into your checking account and your mortgage balance is 200,000. Well, at midnight, that 10,000 gets applied to the mortgage balance dollar for dollar. So it goes from 200,000 minus the $10,000 deposit. So now the mortgage balance is 190,000. Well, now the interest is only accruing on 190,000. So every time you get paid, it goes straight towards the principal balance. So with this product, you truly pay principal first. Now, as I was saying earlier, is there interest? Is there interest cost? Of course there is. You're still borrowing, it's still debt. And the way that the interest works is that is tacked on to the mortgage every month on the 21st of the month based off of the mortgage balance for the last 30 days. So the quicker the mortgage balance is paid down, the less interest that you pay. So just think of a snowball. The faster and the bigger the more deposits that are coming in, and the faster that you get it paid down, the less and less and less in interest that you're going to pay. Now it comes with the line of credit too. You might have a line of credit of 500,000, and you don't have to give up any financial flexibility. The line of credit is going to be based off of how much equity you have in your property. But you don't have to give up any of your financial flexibility. You don't have to change your spending habits at all. And that's just one way to use it. I personally have two all in ones. I got my first one paid off all the way down to zero. And now I use that line of credit. I call it my opportunity cash. Essentially, I have become my own bank. And so when opportunities arise, I'm able to use that line of credit, go pay cash for a property. For example, my brother and I just did our first flip in Tulsa, Oklahoma. We used the line, the all in one, the line of credit to essentially self finance this other property. We paid cash for it via the all in one. Because we were able to do that, I didn't have to mess around with a loan approval. I saved on all of the closing costs that I would normally have with a loan. I was able to get the offer accepted at a huge discount than what I would be, what I would have normally because I was able to close in 7 days. So I got this awesome property for pennies on the dollar. And then we were able to finance all of the repairs from the all in one because of the line of credit. And then we turned around and sold this thing 100 days later and made a significant profit. So I ended up paying literally just a couple $100 in interest. I got the loan paid off in 100 days, and my brother and I walked away with a substantial profit. So think of it as a wealth building tool. It's a way for folks that are serious about building wealth, about paying down their mortgage and having more control over their finances to allow for increased flexibility. And when you have more flexibility, it just allows for creative thinking, more opportunities. Again, this mortgage may not be for you. It probably isn't because 79% of Americans live paycheck to paycheck. You cannot live paycheck to paycheck and qualify for this product. You have to have a very healthy financial profile. The credit requirements are more strict. The debt to income ratio requirements are lower than what they would be on a normal mortgage. You also have to have a reserve contingency of whatever the credit line is. So this product is much more difficult to qualify for because we need to know that the individual applicant really knows what they're doing with their money. But for the individual that does qualify and knows how to use this product, I'm telling you right now, it can be life changing.
And this is something that is not very common on, I would imagine most lenders don't even provide this as an option, right? Is this only available if it's through a bank? Is that part of why you guys are able to provide this at North Point?
Yeah, us at North Point, we provide this product. There's also another bank out there called CMG, who is kind of the founder of this product here in America. Now they've brought us on as a co-partner, so we are the only two institutions out there that both originate and service this product. There are other institutions that will originate this product, but then the servicing it'll end up either with North Point or with CMG because we're the only two institutions that actually service the product, meaning that we have the infrastructure set up for the checking account, the sweep checking account that's linked to the line of credit. What's great is that everything's automated. So when you get paid, the money automatically goes into the checking account, and then it automatically goes to the principal of the existing mortgage. And then automatically on the 21st of every month, the interest accrues. And so if you're someone that's into automation, it's fun because like my brother and I have the all-in-one on a duplex out in Tulsa, and we contribute, around 5 of our rental properties. We send straight towards the all-in-one every month just to accelerate the principal paydown. And we've paid, in a matter of 1 year, we have paid this thing down like 50% almost in just 1 year, where otherwise on a normal 30-year term, we would still have 29 years left to go, and we'd be like $2,000 in. So this mortgage that we have is literally almost paid off 50% in 1 year because of how we're using it, the principal payments that we're making, and the financial discipline that we're exercising. So kind of get back to your question. Most people have never heard of it because the American consumer, there's a couple different reasons. The American consumer is really not ready for a product like this because most folks they just, at the end of the day, they just don't have control over their own personal behavior. They don't have the financial discipline in place. They're too focused on consuming, credit card debt, auto loans, all of these other things that are eating their earning power. And when you have your money, your hard-earned dollars that are going to all these different areas, all these different types of debt, it's just not going to work. And so that is where I always reference, you do have to have a plan. You have to be serious about your money. But for that person, it's very, very exciting. It's not something that a lot of banks offer because there hasn't been a need for it here in America. Because again, our American consumer has experienced so much PTSD from what happened in 2007, 2008. But again, the rest of the world, this is the type of, they use an offset mortgage account. That's how the rest of the world does mortgage. And so it's ironic because here in America, we're so set on the 30-year. And, this is not something that's securitized by Fannie Mae, Freddie Mac, or FHA. So it is considered a portfolio loan. It's not something that there is a secondary market for. But for the right person with the right goals and the right vision, there is no limit to what you can achieve with this product.
Wow, that was very good explanation of all that. If anybody wants just to learn a little bit more about this, I know I just heard you say the term offset mortgage. Would that be another term, I guess, for an all-in-one? Is that another kind of the same term as that's referring to what we're talking about today? Offset mortgage?
That's kind of the European term.
Oh,
And
okay.
let me describe, just for our listeners, this might help, this illustration here. So how it works in Europe with an offset mortgage. Let's say that your mortgage balance, you have a mortgage balance. Let's say that mortgage balance is 500,000. So you have a $500 debt, right? Now, an offset mortgage, let's say with that, so let's just say that bank ABC has your mortgage, and your mortgage with bank ABC is 500,000. Make sense so far? But let's also say that you have $200,000 in a savings account with bank ABC. Well, how an offset mortgage works, instead of getting interest paid on the savings, the money in the savings is applied towards the mortgage, or essentially reducing the mortgage balance. And so instead of interest accruing at 500,000, it only accrues at 300,000 because the balance of the mortgage is 500,000, but then you have 200,000 in a savings account. So the 200,000 offsets the mortgage balance and it comes down to 300,000. So you only accrue interest on the 300,000 versus the 500,000. So that is way more powerful than earning a little interest on the savings when you're able to knock off $200,000 on the mortgage balance as far as the interest that's accruing. So that is how an offset mortgage works. That's the concept behind it. The best part is, in that example, you can access the 200,000 at any point. All you have to do is just move it back over into your checking or savings account. Does that kind of help with the visual?
Yeah. And then you're saying on the 21st of each month with this all-in-one product, they're taking the average of the balance over that 21-day period, or no, sorry, over the last 30-day period, the previous month, basically on the 21st of the month. So if you are concerned about, money going in and out of the account a bunch because you have certain other bills to pay or whatever it may be, that's not a concern. It's just taking that average, and that's what the amount that's getting the interest charged onto it from.
That's right. So the daily interest is calculated at the end of every day. And so whatever the balance is at the end of every day, that is then totaled up at the end of the 30 days. And then the interest is then added on to the mortgage. So let's say, for example, that you have a mortgage balance of 170,000 and and that's been your average balance the last 30 days and the accrued interest is $800. Well, on a normal traditional mortgage, you have to pay that interest out of pocket. So if that interest is $800, you have to write a check to your bank for $800, right? Assuming that it's interest only. If it's not, if it's fully amortizing and it's escrowed, there would be additional on there. But assuming that it's interest only, you would have to write a check for $800 to your bank, and then that is the interest. With the all-in-one, $800 is then just automatically tacked on to the underlying balance. So you don't have to pay for it out of pocket. So that's another really, really cool feature is that you don't have to pay for it out of pocket. And as long as you always have the deposits coming in and your inflows are greater than your outflows, the principal balance will keep going down and down and down. And you'll accelerate the principal pay down through the deposits that are coming in. And you don't have to give up any financial flexibility as long as you are running your budget at a surplus every month, meaning more money is coming in than is going out. You don't have to change any of your spending. And that first example that I gave, the person on the 30-year fixed at 2.9%, they actually have to change their spending habits to accelerate the principal pay down because they have to pay additional principal, and that means additional cash flow. If you're running your balance and your budget at a surplus, you don't have to change your spending habits.
That sounds really powerful. Very cool. Well, guys, if you have any follow-up questions, which I'm sure you might, Ben will definitely be the one to answer any of those for you. We'll make sure and include his contact info in the show notes on this episode. But Ben, if they want to just get a quick other way to reach out to you, what would be the best way?
Go to Ben Adams, just search Ben Adams North Point, and my webpage will come up, and you're welcome to just send me a message, and it'll come straight to me.
Sweet. Cool, guys. So I think this all-in-one, again, can be a very powerful tool for that select few. Hopefully that 79% that this doesn't apply for, hopefully the percentage of people listening and watching our podcast, hopefully that percentage is a little bit better on this group of people. But regardless, definitely need to just kind of tread lightly on this one and make sure you're very informed and educated before jumping into anything like this. But man, it sounds like a very powerful tool. And I think not only just from a concept, but from actual, you're, legitimately using this and having success with it, and the proof is in the pudding with what you've been able to do with this.
Yeah, thank you so much. And just to wrap things up here, you're exactly right. It is a tool. Think of it as a hammer. You can go build a home with a hammer, or you can go break glass, break windows. And so ultimately, this is a really powerful tool, but it is up to the individual on how they use it. And so that's where it's important to have those skills, have those habits built out. And if you're someone that does, and you don't live paycheck to paycheck, and you understand how personal finance and money management work, wow, you can use this tool to accelerate whatever you're doing.
Love it. Well, thanks, Ben. You guys, hope you enjoyed this one on another episode of the Pursuit of Progress podcast. Ben, hope you're having a great rest of your day. And you guys, we'll see you next week on an all new episode. See you then.
Okay. Love you guys. We'll see you next week.